Hello, I'm Chris Pedersen, and this is Stockwatch on Wednesday, the 24th of July, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations. First off, the ASX 200 has broke 8,000. However, it immediately fell back below and is currently trading around 7,950. Well, the reality of the ASX 200 is it's dominated by banks, the Big Four, and Big Four miners. With bank stocks overvalued and the big miners, iron ore miners, and the price of iron ore declining, it's going to be hard for the ASX 200 to continue rising, even if global markets rise. However, I happen to believe that the rest of the market can more than make up for these hindrances. My view is the ASX 200 will move over 8,000 and continue up. Just won't rise as fast as like the S&P 500. Last night, Tesla reported a miss in the analysts' expectations on earnings. This is now the fourth reporting period in a row. Doesn't look good for Tesla. US elections now have a competitive contest. Game on, is my saying. It's the prosecutor versus the felon. This election will have global impact on an economic basis. Normally, elections are not so important. Over the month of August, I will elaborate more on what is known as the Trump trade. Overall, markets are in good shape, and we're in a sweet spot that until we find out that there's some bad news lurking out there, the market should drift sideways towards upwards. Lithium. Now, everybody talks about lithium constantly. This is a chart that shows supply and demand. What we see right now is that supply is outstripping demand, and that is why the price is weak. And this is going to continue for a while. However, if you look at the chart and you go to the far right, you'll see that demand will, by around 2029, look to maybe outstrip supply, in which case, getting set in lithium while it's really low, if this chart is accurate, we do have to wait like 4 or 5 years before we find out. The lithium, you could be buying cheaply now. Personally, it's too long to really estimate. A lot can change between now and then. I remain kind of neutral on lithium and avoid it. Reporting season in US expectations. This goes back to 2022, so it's not all that far back. But what it shows, the black, is positive expectations. The markets, investors are all looking at good signs, good indications of further growth. This is contrary to a lot of economists that are predicting a recession. Is private equity losing its luster? This chart shows the amount of private equity deals that are supposed to be exiting being delayed. What we see in 2021 is a huge spike upwards, but this is normal. This was COVID, so a lot of business deals got put on hold. But after that, we still see there's an elevated number of private equity deals that are being postponed. This is not really good for private equity. These deals have to be refinanced. Investors want to exit at certain time frames, so PE is now finding new investors to come in and take out the old investors. Buyers of Russian gas. This is a fascinating chart. The black line is European buyers. As we see, after the Ukraine war, Europeans dramatically reduced the amount of gas they're buying from Russia. And we expected that China would be a big buyer of gas. But you see from this chart, China hasn't really been increasing their buying of Russian gas. So the question remains, where's Russia making all their money? Right now in the United States, there's an election for president coming up on the first Tuesday in November. What we hear is saturation of noise out of both candidates. Ignore it. Look at the facts. Mostly just look at company fundamentals, interest rate fundamentals. But an interesting statistic that crossed my desk this morning was from Bloomberg, and it showed that during the Biden presidency, the best performing sector was energy. It was beating technology. Now, to me, that was a shock. During the Trump presidency, energy was the worst performing sector. Right now it's Trump saying, drill, baby, drill. The problem with this is it lowers prices and kills profits. This is all before COVID hit with regard to Trump's performance in the energy sector. Oil prices are right now in a sweet spot. They're also a good indicator of economic strength, in addition to supply and demand. Here is a chart that shows the energy sector versus other sectors in the US market. Energy sector is green, and you can see that it's dramatically outperformed. The white is the tech sector. Two companies I want to cover today. First is Woodside Energy. They reported production yesterday and an acquisition of a natural gas terminal port in Louisiana. The code on the ASX is WDS. It's currently trading around 27.24. This chart shows up and down, sideways. Doesn't really have a clear direction other than for the past 6 months it's been downwards. Fundamentally, let's take a look because all the brokers have updated their estimates. These, by the way, are UBS. First off, Woodside has a market cap of around $54 billion. Price target by UBS is $31. Other brokers are more like $28. The Morgan Stockbroking is up at $35. Revenue growth from 2023 through 2026 is estimated at -2% per annum. The earnings per share growth during this time is -4% per annum, and dividend growth is also -4%. The PE on Woodside's 2025 earnings per share estimate is around 14 times. The yield on the 2025 dividend estimate is around 6%. Free cash flow is 7.5%. The payout ratio is around 80%. So Woodside Petroleum is an oil and gas producer. It's a play on future pricing. First off, it's a great company, well run. They're buying that liquid natural gas plant in Louisiana. I like the company. I've always liked it. I felt management is excellent. However, I'm not so sure about the forward fundamentals, forward pricing. I rate it neutral. SG Fleet Group on the ASX code is SGF. It's currently trading around $3.16. This is a 5-year chart. Also, it's all over the place. So let's look at the numbers to see if it's a buy. First off, the estimates are by Canaccord. It's a market cap of about $1.1 billion. 12-month price target they have is $3.65, and this is based on discounted cash flow and price earnings ratio. The revenue growth rate for each of the next 3 years is around 5.4%, and the earnings growth is around 7.4% each year, and dividend growth is growing at 7.7% each year. These are solid numbers. Earnings growth and dividend growth is very attractive when it's steady. The PE on the 2025 estimate for earnings of 29 cents is only 11 times. The yield on the 2025 dividend estimate of 19 cents is 6.9%. This is attractive. Free cash flow is around 6%, and the payout ratio is only 65%, so they are retaining earnings for future liabilities or for growth. Simply, it's a car leasing company for fleets. Other companies in this sector are FPR, MMS, SIQ. These are all fairly similar with their fundamentals. I like it, but it does have competition. I rate it a buy, but only a half weight. As always, if you have any requests for more information, send an email to stockwatch@fnn.com.au and request me, Chris Pedersen. Have a wonderful week. Thank you.